Today, we're diving into a fascinating contradiction that's playing out on Wall Street right now. You've got the big indexes hitting these crazy record highs, but at the same time, there's this nervous energy just bubbling right under the surface. So what's the real story here?
Okay, let's unpack this quote, because it just nails the mood perfectly. On one hand, you see all these headlines celebrating a super strong market, but on the other, the people actually in the market, they're feeling pretty tense. So we're going to look at both sides. First, that calm surface the headlines are showing us, and then we'll dig into the anxiety that's hiding just underneath.
All right, let's start with what looks like a calm surface. This is the story you're seeing in the headlines, right? The picture of a really robust and confident market, driven by these big positive numbers that kind of suggest everything's going great.
First up, you've got the Dow Jones Industrial Average. I mean, it's been hovering right around this record high. And yeah, there have been some minor dips, but for the most part, it's projecting this image of real strength and stability.
And hey, it's not just the Dow. The S&P 500, which gives us a much broader look at the market, is also holding really strong. This tells us the positive vibe isn't just limited to a few big-name stocks. It seems to be pretty widespread.
And adding to this picture of calm is the US dollar index. It's actually weakened a little bit. Now that might sound bad, but it can often be a good thing for stocks. Why? Well, it makes US goods cheaper for other countries to buy, and that can really boost the profits of our big multinational companies.
You know, this quote right here is the perfect pivot point for our story. The numbers we just looked at, they paint one picture, but they don't tell us a thing about how investors are actually feeling. So let's peel back that layer and see what's really going on.
Okay, now for the juicy part. The anxiety lurking beneath all those big numbers. This is where it gets really interesting, because we're moving past the headlines to understand the real fears driving decisions for investors on the ground.
So what is really happening here? What are the hidden pressures that are causing this huge disconnect between the market's record highs and the anxiety everyone's feeling? Well, it really boils down to three major factors. First off, you've got these stubbornly high interest rates from the Federal Reserve, which are acting like a brake on the whole economy. Second, and we're going to dig into this one in a sec, corporate earnings are telling two completely different stories. And third, there's that constant background noise, geopolitical uncertainty and the ever-present risk of a government shutdown.
And this brings us to this idea of split earnings, which is fascinating. What's happening is a handful of, mega cap tech companies are doing so incredibly well that they're basically holding up the entire market average. But this masks some serious weakness in other really important sectors like industrials and smaller companies, and that creates a huge risk, right? If just a few of those giants stumble, the entire market is going to feel it.
So, with all these risks hiding under the surface, how are investors reacting? Let's take a look at what the so-called smart money is doing, and you'll see it's a very clear shift away from optimism and towards caution.
The first sign? Volatility. That measure of price swings and general nervousness in the market, it's quietly starting to creep back up. So even with the indexes near their peaks, there's this growing feeling that things could get pretty bumpy pretty fast.
And this growing sense of caution is leading to a classic strategic shift. Investors are starting to pull their money out of those high-risk, high-reward growth stocks and putting it into more stable, defensive parts of the market.
So what exactly are these defensive sectors? Well, think about companies that provide things we absolutely need, no matter what. People still need electricity, they still need healthcare, they still need to buy groceries, right? So this move, this pivot, it's a really clear signal that investors are bracing for potential trouble ahead.
But at the very heart of all this caution is one single crucial number, the yield on the 10-year Treasury note. At around 4.5%, this has become one of the single biggest factors driving what investors are doing right now.
So why does this one number matter so much? Well, think about it. A higher Treasury yield offers you a safer return. Why would you gamble on a risky stock when you can get a nearly guaranteed return from a government bond? So as long as this yield stays high, it acts like a gravitational pull on the stock market, keeping it from flying much higher. And all of this brings us to the final big question. What happens next? With all these conflicting signals, you've got high indexes on one hand and super nervous investors on the other. The market is just holding its breath. So what can we expect?
Well, the general consensus among analysts isn't doom and gloom. Nobody's really calling for a major crash. It's more like a period of what you might call mild volatility, a kind of sideways, choppy market as everyone just waits. So what is everyone waiting for, exactly? In a word, clarity. A clear signal from the Federal Reserve. The entire market is basically on pause, waiting for some guidance on what's going to happen with interest rates.
And this quote just says it all, doesn't it? The Fed is trying to pull off this tricky maneuver called a soft landing. Slow the economy just enough to tame inflation, but without causing a full-blown recession. Investors are just holding their breath, hoping that this delicate balancing act doesn't become a sudden, painful, hard stop for the economy.
If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.